Warren Buffett. The name conjures up images of, well, legendary investing success. But if you've ever felt like understanding his magic requires wading through dense financial reports, you're definitely in the right place.
hmm Welcome to the Deep Dive. Our mission today, to distill the core wisdom from detailed outlines of books about Buffett's life and principles. Think of this as your express ticket, sort of to grasping the insights that have powered his incredible journey without getting lost in the financial weeds.
Exactly. And we're not just defining terms here, we're really extracting the foundational ideas, those mental models that underpin Buffett's whole approach to investing and, business itself.
Right.
We'll explore how seemingly small moments in his early life really shaped his financial intuition, and how a chance encounter with a book really set him on a path to revolutionize investing.
And it's fascinating to see how it all began right there in Omaha. Running his family's grocery store gave him this real-world education in the nuts and bolts of business.
Oh, absolutely. Practical experience. And his father's work in finance planted that initial seed of interest. Even selling Coke and delivering newspapers. They weren't just kid jobs, they were like early lessons in sales, customer service, and the value of hard-earned cash.
What's really fascinating is how these weren't abstract lessons for him. He wasn't just reading about profit margins. He was experiencing them firsthand, counting the pennies, basically. Take his first stock purchase at age 11. He made a quick buck, sure, but then saw the stock soar after he sold. That early experience just seared into his mind the risk of trying to time the market, a lesson he clearly never forgot.
Yeah, you can see that playing out later. And then came a truly pivotal moment, right? Discovering Benjamin Graham's The Intelligent Investor.
Oh, huge. Life-changing, he called it.
And you can see why. Graham laid out this revolutionary idea. Every stock has an intrinsic value, a true underlying worth, and the key is to buy it for significantly less.
That margin of safety.
Exactly, the margin of safety.
Right. Buffett was so taken by Graham's ideas that he actually went to Columbia specifically to study directly under him, and later even worked at his firm, Graham Newman Corp. That was his deep immersion, applying those core principles in the real world. And while Buffett's approach definitely evolved over time, that Graham foundation of value and safety remained absolutely crucial.
Okay, so Graham was all about finding these really cheap stocks, almost like picking up discarded cigar butts for one last puff, as the saying goes.
Yeah, the cigar butt approach, statistically cheap.
But Buffett shifted gears. He started talking about buying wonderful companies at fair prices. What sparked that change?
Well, what's really insightful here is recognizing that cheap stocks aren't always a bargain.
Yeah.
Right? Sometimes a company is cheap for a reason. Its business might be fundamentally flawed or just not great.
Right, cheap for a reason.
Exactly. Buffett, especially with the influence of his partner Charlie Munger, realized that exceptional businesses, the ones with strong brands or, dominant market positions, are far more likely to generate substantial profits over the long run.
Okay.
So instead of just focusing purely on a low price tag, he started prioritizing the inherent quality and the long-term prospects of the business, even if it meant paying what seemed like a fair price, not just a rock-bottom one.
And this intrinsic value, it sounds like the holy grail of investing, but it's not printed on a stock certificate, is it? How does Buffett even begin to figure that out?
You're right. It's more art than exact science, definitely. Buffett sees intrinsic value as your best estimate, really, of all the cash a business will generate in the future, discounted back to today's dollars.
Oh, okay. So future looking.
Very much forward-looking,
Right.
based on informed projections. He contrasts this sharply with book value, which is simply a snapshot of a company's assets minus its liabilities, an accounting measure that, honestly, often doesn't tell you much about its future earning potential.
Yeah, book value feels very static. I recall reading about a two-column valuation method he used specifically for valuing his own company, Berkshire Hathaway. What was the thinking behind that?
Well, for a sprawling conglomerate like Berkshire, with its, diverse mix of investments and operating businesses, a simple valuation metric just wouldn't cut it. It's too complex.
Right.
So Buffett essentially broke it down into two main parts. First, the value of Berkshire's significant stock market investments, and second, the earning power of its non-insurance operating businesses.
Okay.
He'd estimate a reasonable value for each of these columns and then add them together to get a sense of Berkshire's overall intrinsic worth. It's a very practical way to handle a uniquely complex entity like Berkshire.
Makes sense. So when he's evaluating a company to potentially invest in, not Berkshire itself, What are the key financial numbers he's scrutinizing? What are his sort of go-to signals?
He looks at several vital signs. One of the most important is return on equity, or ROE.
ROE, right.
Think of this as how effectively a company is using the money shareholders have invested to generate profits. A consistently high ROE compared to its competitors over many years, say 5 to 10 years, can be a hallmark of a business with a durable competitive advantage.
That economic moat thing.
Exactly, what he calls an economic moat, which we'll definitely dig into later. The formula for ROE is pretty simple. Net income divided by shareholders' equity.
Got it. ROE. What else catches his eye? Debt levels.
Oh, definitely. He pays close attention to the debt-to-equity ratio. This tells you how much a company relies on borrowed money compared to its own capital.
Right.
Buffett generally prefers companies with low levels of debt because, too much debt can make a company really vulnerable during tough times.
Yeah, that makes intuitive sense.
The formula here is total liabilities divided by shareholders' equity. Then there are profit margins. Ideally, you want to see healthy margins that are consistently expanding over several years. That suggests strong management and maybe some pricing power.
Okay. And what about things like PE ratios, price to earnings?
He looks at price to earnings, PE, and price to book, PB ratios, absolutely. But he emphasizes they're just starting points. They're tools, not the whole story by any means.
It's just part of the picture.
Exactly. A low PE might suggest a company is undervalued relative to its earnings, and a PB below 1 could indicate it's trading for less than its asset value. But these need to be considered within the broader context of the business, its quality, its future.
So it's really not just a numbers game for Buffett then. There's a lot more to his analysis than just spreadsheets and ratios.
Absolutely, not just numbers. These financial metrics are just pieces of a much larger puzzle. Buffett places a huge emphasis on truly understanding the underlying business, its competitive landscape, the strength of its brand, and, crucially, the integrity and competence of its management team.
Management quality, yeah.
Remember, Charlie Munger's influence really pushed Buffett to look beyond just cheap numbers and focus on the enduring quality of the enterprise. It's about the whole package.
Now, let's circle back to that margin of safety again. It sounds crucial. You mentioned it was foundational, but how does he actually put that into practice? What does it look like?
The margin of safety is, well, it's the bedrock of Buffett's risk-averse approach. Think of it simply as the discount you demand between your estimate of a stock's intrinsic value and the price you're willing to pay.
Okay, the gap.
Exactly, the gap. Benjamin Graham saw it as a buffer against errors in your analysis or unexpected negative events, things going wrong.
Which they sometimes do.
Which they inevitably do sometimes.
Yep.
Buffett often aims for a significant discount, sometimes as much as 30% or even 50% below his estimated intrinsic value, especially for certain types of businesses.
So it's like saying, okay, I think this is worth $100, but I'm only going to touch it if I can get it for, say, $70 or maybe even $50.
That's precisely it. The formula, if you want one, is basically margin of safety, you won one. Current stock price, intrinsic value per share. While a general target might be in the 10% to 20% range for some, Buffett often looks for much wider margins when he can find them. And the beauty of this approach is it significantly reduces your downside risk. Even if your valuation is a bit off or if the market takes a temporary nosedive, you have that built-in cushion protecting you.
Like insurance?
Sort of, yeah. As Buffett himself famously said, the 3 most important words in investing are margin of safety. He really hammers that home.
That really underscores its importance. But in today's markets, which often seem pretty efficient, are these big margins of safety easy to find? Seems like it would be tough.
Oh, not at all easy. It requires, first, a good dose of humility, recognizing that your analysis might not be perfect, that you could be wrong.
Sure.
And second, it requires a tremendous amount of patience and discipline. You have to wait for the market to misprice opportunities, for Mr. Market, as Graham called him, to offer up those wonderful businesses at a significant discount.
You can't force it.
You absolutely can't force it. It's about being selective and resisting the urge to invest in just anything because you happen to have cash sitting around. You wait for the fat pitch.
Another key Buffett principle we hear a lot about is the circle of competence. Can you break that down for us simply? What does he mean?
Sure. Imagine a circle, right?
Yeah.
Inside that circle are all the industries and businesses you genuinely understand, how they make money, their competitive dynamics, what makes them tick, their key drivers.
Okay.
Buffett's core idea is incredibly simple. Only invest within that circle, as he famously put it. The size of the circle is not very important. Knowing its boundaries is vital.
So it's really about staying in your lane,
Yeah.
investing only in what you actually know and understand.
Precisely. The primary benefit is that it drastically reduces your risk of making uninformed decisions, of essentially gambling. If you genuinely understand a business, you're much, much better equipped to assess its long-term prospects and its true value.
Makes sense.
If you venture outside that circle, you're essentially speculating, hoping for the best. Buffett, for instance, famously avoided the early internet boom, the dot-com bubble, largely because he admitted he didn't fully grasp those business models at the time.
But what if your circle of competence feels, well, kind of small? Does that limit your investment opportunities significantly?
Well, your circle isn't fixed in stone. It can definitely expand over time through dedicated learning and effort.
Ah.
However, that learning should be focused, and ideally within areas that are adjacent to your existing knowledge or genuinely pique your intellectual curiosity.
Mm.
The crucial element here is intellectual honesty, admitting what you don't know and having the discipline to steer clear of investments you don't understand, no matter how tempting they might appear, no matter what everyone else is doing.
Avoiding the FOMO, the fear of missing out.
Exactly. It helps you avoid FOMO and leads to a much more rational and sustainable investment approach over the long haul.
Now, Buffett is renowned for his incredibly long-term investment horizon. What's the philosophy behind this emphasis on patience? Why hold forever?
Well, Bucket's perspective on holding periods is almost legendary, isn't it?
Yeah.
He famously quipped, "Our favorite holding period is forever."
Yeah.
He stands in stark contrast to the short-term trading mentality that often dominates the market noise. He firmly believes that trying to predict short-term market fluctuations is not only futile, but actually counterproductive to good returns.
A waste of energy?
A total waste of energy, potentially damaging. He often likens investing to owning a farm or a family business. You're in it for the long haul, focusing on the underlying productivity and growth over years, even decades, not days or weeks.
And this long-term view is intrinsically linked to the power of compounding, right? That's where the real magic happens.
Oh, absolutely fundamental. Buffett frequently illustrates the magic of compounding with that wonderful analogy of a snowball rolling down a long, sticky hill.
Right, getting bigger and bigger.
Accumulating more and more snow as it goes. The longer the hill, the longer you hold your investments and, crucially, reinvest the earnings like dividends, the more powerful that compounding effect becomes. It grows exponentially over time.
So temperament is key.
Temperament is absolutely key. He stresses that emotional discipline is vital here. As he famously said, the stock market is a device for transferring money from the impatient to the patient. Panicking and selling during market downturns essentially stops your snowball dead in its tracks, or worse, shrinks it.
He even has a pretty straightforward recommendation for the average investor, the person who doesn't want to actively manage their portfolio day to day, doesn't he?
Yes, he does. For most individuals, Buffett advocates a remarkably simple and patient strategy, the 90-10 rule.
90-10.
He suggests putting 90% of your investment dollars into a very low-cost S&P 500 index fund, just tracking the broad market, and the remaining 10% into short-term U.S. government bonds.
Okay. And the thinking there?
The rationale is pretty clear.
Okay.
Capture the long-term growth of the broad American economy with minimal effort, minimal fees, and minimal stress. But even with this passive approach, the core principle is patience, sticking with the plan through market ups and downs. Just keep buying over time.
Another term that pops up frequently in the Buffett lexicon is economic moats. We mentioned it earlier. What exactly are these, and why are they so vital to his investment decisions?
Yeah, the moat analogy is fantastic. Think of an economic moat as a company's durable competitive advantages, the factors that protect its profitability and market share from being eroded by competitors.
Like a castle moat.
Exactly like a castle moat protecting it from invaders. These advantages shield a company's profits. Buffett prioritizes companies with wide and sustainable moats because these provide a high degree of confidence that the business will continue to generate strong returns on capital over the long term, year after year.
Can you paint a picture of some different types of economic moats? What do they actually look like in the real world? Give us some examples.
Sure, there are several common types. One powerful moat is brand power or brand recognition. Think of Coca-Cola or Apple.
Instantly recognizable.
Right. Their strong brands foster intense customer loyalty and allow them to command premium pricing. Another is being the low-cost producer, like Walmart or Costco or Geico in insurance. Their scale and efficiency enable them to offer lower prices than competitors, which is tough to beat.
Makes sense.
The network effect is another compelling moat, where a product or service becomes more valuable as more people use it. Think social media platforms like Facebook or payment platforms like Visa or MasterCard.
Right. The more people use it, the better it is.
Exactly. High switching costs can also create a moat because it's difficult or expensive for customers to change providers. Think about specialized enterprise software from companies like Oracle or even the Apple ecosystem. Once you're in, it's hard to leave.
Yeah, definitely felt that one.
And finally, you have things like patents, trademarks, and regulatory licenses, which can provide legal protection against competition, like we see in the pharmaceutical industry with drug patents. Certain industries also just have inherently high barriers to entry due to the significant capital investment or specialized expertise required, think semiconductor manufacturing or maybe telecommunications infrastructure.
But these moats, they aren't permanent, are they? They can weaken over time, presumably.
That's a crucial point, absolutely. Moats can erode. Technological disruptions, shifts in consumer preferences, new regulations, or just the emergence of really sharp, innovative competitors can weaken even seemingly strong moats.
So you have to keep watching them.
Constantly. That's why Buffett emphasizes the need for ongoing analysis of a company's competitive position. Are the walls holding? Is the moat widening or shrinking? Companies with strong and ideally widening moats are those most likely to generate those consistently high returns on equity and the owner earnings we might discuss later.
Okay, so you've identified a company with a strong moat. That's a big piece. What else is Buffett looking for? It's not solely about the business itself, the structure, is it? Management matters too.
Oh, immensely. You're absolutely right. Buffett places immense value on the quality of the people running the business. He famously said something like, when a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact.
Huh. Yeah, the business wins.
The business usually wins. So he seeks out what he calls wonderful businesses, those that are relatively easy to understand, have a consistent, positive track record, and possess promising long-term prospects. But then he pairs that with top-notch management.
And what qualities does he look for specifically in a management team? What makes them top-notch in his eyes?
He looks for rationality, first and foremost, especially in their capital allocation decisions. Are they smart about how they use the company's money?
Like deciding between reinvesting, acquisitions, dividends.
It's exactly. Reinvesting in the business, making smart acquisitions, issuing dividends, or buying back shares. Are they doing it in a way that's focused on maximizing long-term shareholder value? That's critical.
Okay. Rationality.
He also values candidness and transparency in their communication with shareholders. Do they tell it like it is, good and bad? He looks for a resistance to the institutional imperative, just following the herd or doing what other companies do.
Thinking independent.
Thinking independently and thinking and acting like true owners of the business, not just hired hands. Buffett also favors executive compensation structures that are clearly tied to long-term profitability after accounting for the cost of capital. And shareholder-friendly policies, like buying back genuinely undervalued shares and reinvesting earnings only when high returns are clearly anticipated, are also key indicators for him.
We touched on this earlier, but the evolution of Buffett's strategy from Graham's strict, almost statistical value focus to including these high-quality businesses is often called the Munger Revolution.
Yeah,
Can you elaborate a bit more on Charlie Munger's specific impact there?
absolutely. Buffett's early approach, heavily influenced by Graham, really involved seeking out deeply undervalued companies, often those with significant asset value trading below even liquidation value, that cigar butt strategy we mentioned.
Right. Finding discarded value.
Finding value others missed, often in mediocre businesses. Charlie Munger, Buffett's longtime business partner and, frankly, intellectual sparring partner, played a pivotal role in broadening his horizons. Munger argued persuasively, relentlessly, that it was far better in the long run to buy a truly outstanding business at a fair price than a mediocre business at a bargain basement price.
And See's Candies is often cited as the prime example of this shift in action, isn't it? That was key.
Exactly. The 1972 acquisition of See's Candies for $25 million wasn't a classic deep value play based on assets. It was a business with a powerful, almost cult-like brand, incredibly loyal customers, and the ability to consistently raise prices without significantly impacting demand pricing power.
The power of the brand.
Immense power. Buffett himself readily acknowledges that the lessons learned from See's, particularly the value of intangible assets like brands and the importance of exceptional management, like Chuck Huggins at See's, heavily influenced his subsequent much larger investments, like Coca-Cola.
Interesting connection.
And this focus on quality also proved to be a much more scalable strategy as Berkshire's capital base just exploded over the years. You can deploy more money into great businesses. Munger's contributions extended way beyond just this shift, though, encompassing areas like advocating for a concentrated investment portfolio, the importance of using diverse mental models for decision-making, and a deep understanding of behavioral economics and avoiding psychological pitfalls.
So it was really an evolution building on Graham.
Definitely an evolution, not a rejection.
Yeah.
Adding a critical emphasis on business excellence alongside value.
Okay, let's delve deeper into how Buffett assesses a company's true profitability. He has his own preferred metric, you alluded to it, owner earnings. Can you explain what that is in practical terms? How does it differ from regular net income?
Right, owner earnings.
Yeah.
It's a concept Buffett introduced way back in his 1986 shareholder letter, and it's his attempt to get at a company's real, sustainable cash-generating power from the perspective of an owner, someone who actually owns the whole business.
Okay, makes sense.
He defines it, roughly, as the cash that could theoretically be taken out of the business during a year without negatively impacting its long-term competitive position or its ability to maintain its unit volume and generate future profits.
So the truly free cash, how do you calculate it?
There are a couple of common ways to approximate it. One approach is to take the reported net income, add back non-cash charges like depreciation and amortization, because those aren't actual cash outflows, right?
Right, accounting charges.
Exactly. And then, crucially, you subtract the estimated maintenance capital expenditures, the essential investments needed just to keep the business running at its current level, replace worn-out equipment, things like that.
The stay-in-business CapEx.
The stay-in-business CapEx. Exactly. Another way to think about it is to start with operating cash flow from the cash flow statement, and then just subtract that same maintenance CapEx number.
Okay, so why does Buffett consider this a more insightful measure than the standard net income figure everyone reports?
Well, Buffett believes net income, as reported under generally accepted accounting principles, GAAP, can sometimes be misleading. It can be influenced by various accounting conventions, non-cash items, and management choices.
Subjectivity.
A degree of subjectivity, yes. More importantly, owner earnings explicitly subtract that crucial maintenance capital expenditure, which is a very real cash cost for any business owner trying to keep the operation going. He points out that many commonly cited cash flow figures often don't properly deduct this necessary reinvestment, thus potentially overstating the cash that's truly available to be distributed to owners or used for growth.
So it's more conservative.
Much more conservative, yes, and arguably a more realistic assessment of a company's sustainable earning power over time.
Now, a significant driver of Berkshire Hathaway's incredible success is its massive insurance operations. What's the magic, as he calls it, of float in Buffett's strategy?
Insurance float. It's a fascinating and powerful concept. Float is essentially the money that insurance companies collect in premiums before they have to pay out on future claims. People pay up front, claims come later.
So they hold on to the cash for a while.
Exactly. Berkshire Hathaway has amassed a truly staggering amount of float over the decades. I think it was over $168 billion as of the end of 2023.
Oh, wow. That's a lot of money.
It's an almost unimaginable amount of money. And the crucial advantage is that Buffett gets to hold and invest this vast sum of money, essentially interest-free until the claims need to be paid, which could be years or even decades later for some types of insurance. It acts like a giant zero-cost long-term loan.
That's an incredible source of capital. So this float is what allows him to make those big strategic investments we often hear about, like Coke or Amex.
Precisely. Think of some of Berkshire's most iconic long-term investments. Coca-Cola, American Express, Fruit of the Loom, BNSF Railway. The readily available capital from the insurance float played a significant role in funding many of those acquisitions and large stock purchases over the years.
Gives him firepower.
Tremendous financial flexibility and firepower, particularly during market downturns, when attractive investment opportunities might suddenly...
That really is remarkable synergy. Let's pivot slightly to the role of a company's CEO. In Buffett's eyes, we talked about management quality, but what is their single most paramount responsibility?
For Buffett, a CEO's most critical function, above all else, really, boils down to the intelligent allocation of the company's capital, how they deploy the money the business generates.
Capital allocation.
Capital allocation. As he famously stated, over time, the skill with which a company's managers allocate capital has an enormous impact on the enterprise's value. He views this as potentially even more crucial than their day-to-day operational expertise. It's about making smart, strategic decisions on how to deploy the company's financial resources to maximize long-term returns for the owners, the shareholders.
What are the primary avenues through which a CEO can allocate that capital? What are the main choices they typically face?
They have several key options, generally. They can reinvest earnings back into the existing business to fuel organic growth, things like expanding operations, investing in research and development, boosting marketing efforts.
Growing from within.
Growing from within, yes. They can acquire other companies that offer strategic synergies, new markets, or growth opportunities. That's inorganic growth,
M&A.
right? Mergers and acquisitions. They can return capital directly to shareholders through paying dividends or by repurchasing the company's own stock in the open market, particularly effective when they believe the stock is trading below its intrinsic value.
Buybacks, yeah.
They can also choose to pay down debt to strengthen the company's balance sheet and financial position. Or finally, they can simply retain the earnings and hold cash in reserve, building a war chest for future opportunities or to weather potential economic storms.
So lots of choices. What's the key to doing it well?
The key is a rational and disciplined analysis of the potential returns and the associated risks of each option. Always comparing the potential return on investment, ROI, of one choice versus the others, and always keeping in mind the opportunity cost, which you're giving up by choosing one path over another. Buffett's own approach at Berkshire, historically, has largely been to acquire outstanding businesses with strong management teams already in place, let those teams operate autonomously, and then selectively repurchase Berkshire shares when he deems them significantly undervalued. He's also now got Greg Abel lined up, known for his capital allocation skill.
Okay, to truly understand how Buffett's principles translate into real-world success, let's maybe delve into some of his most talked about investments as case studies. Let's start with See's Candies again. We touched on it, but what were the really enduring lessons from that acquisition?
Yeah, See's Candies, 1972, $25 million. It was a watershed moment, as we said. Buffett and Munger recognized a business with not just a product, but a powerful and enduring brand, fiercely loyal customers, especially on the West Coast, and significant, largely untapped pricing power.
People would pay more.
People would pay more, and they did, year after year. Importantly, it was also a business that generated high profits without needing substantial ongoing capital investment to maintain its position. It gushed cash.
Low capex, high return.
Exactly. The fundamental lesson was the immense and often overlooked value of intangible assets like brand strength and customer loyalty and the pricing power they afford. This acquisition really solidified Buffett's shift towards prioritizing high-quality businesses, even if they weren't statistically cheap by Graham's old metrics. And it highlighted the critical importance of excellent management, exemplified by Chuck Huggins, who ran See's for decades.
And it influenced Coca-Cola, you said?
Directly. Buffett himself has explicitly stated that the insights gained from See's understanding how a brand could create that pricing power and loyalty directly influenced his later, much larger investment in Coca-Cola. See's was like the pilot program.
Speaking of Coca-Cola, that's another absolute cornerstone of the Berkshire portfolio. What attracted Buffett to that huge investment back in the late 1980s?
Right. Berkshire Hathaway began accumulating shares of Coca-Cola in 1988, ultimately investing over $1 billion, which was a massive sum then, for about 7% of the company.
Big bet.
Huge bet. Buffett was drawn to its globally recognized and incredibly strong brand, maybe the strongest global brand at the time, its consistent and substantial cash generation, and its vast, still largely untapped potential for growth in international markets.
Global reach.
Huge global reach. He also deeply respected the shareholder-focused management team at the time, led by Roberto Goizueta and Don Keough, who he felt were making smart decisions.
Management again.
Management again. And true to his long-term philosophy, Buffett has held on to those shares basically forever. The annual dividends Berkshire now receives from Coke alone far exceed its original investment cost. The yield on cost is astronomical, over 60% now.
Incredible.
It's a classic illustration of the enduring value of dominant global brands, the power of truly long-term holding, and the remarkable magic of compounding those reinvested dividends over decades.
And then there's Geico, the insurer. That relationship goes way, way back for Buffett, doesn't it? Even before Berkshire.
Indeed. Buffett's initial fascination with Geico dates back to the 1950s, believe it or not, largely due to his mentor Benjamin Graham's connection. Graham was actually chairman of Geico back then.
Wow, small world.
Tiny world in value investing back then. Buffett visited the company, met Lorimer Davidson, and was deeply impressed by Geico's innovative, low-cost, direct-to-consumer business model. Selling insurance without agents gave it a significant, sustainable cost advantage.
The moat.
A powerful moat. He made a substantial early investment, like 65% of his net worth at the time. but later sold it, a decision he openly admitted he came to regret deeply.
Sold too early.
Sold way too early. However, when Geico faced near bankruptcy, serious financial difficulties in the mid-1970s, Buffett saw an opportunity. He recognized the underlying strength of the business model hadn't vanished, so Berkshire started reinvesting heavily, eventually leading to Berkshire Hathaway acquiring full ownership in 1996.
So what are the takeaways there?
Well, the enduring power of a truly superior low-cost operating model, recognizing significant growth potential even in companies that might look like traditional value stocks, the importance of having deep conviction when making substantial investments. And it also illustrates that sometimes second chances do arise with exceptional companies if you're patient and prepared. And again, the role of management, first Davidson and later Tony Nicely, was crucial.
The American Express investment during the salad oil scandal in the early 1960s, that's a really compelling example of Buffett's contrarian thinking, isn't it? Going against the panic.
Oh, absolutely classic Buffett.
Yeah.
In 1963, a massive fraud scandal involving a company called Allied Crude Vegetable Oil Company, which had borrowed heavily against fake inventory using Amex warehouse receipts, sent American Express's stock price plummeting as investors panicked about Amex's liability.
Market freaking out.
Total market freakout. However, Buffett, after doing his homework, his typical deep dive, recognized that Amex possessed a fundamentally strong core business in its traveler's checks and its growing credit card divisions. He believed the market was dramatically overreacting to what was likely a temporary, albeit serious, crisis.
Saw past the noise.
He saw past the noise and believed the company's strong brand and reputation for trust, which they reinforced by making good on the claims, would ultimately prevail. He made a significant contrarian investment, about $20 million for 5% of the company, when the stock was crushed.
And it worked out.
It worked out spectacularly. American Express successfully navigated the crisis, its stock price rebounded strongly over the next few years, and Buffett made a handsome profit. The core lessons here are absolutely fundamental to his approach. The importance of being greedy when others are fearful, focusing on the long-term intrinsic value of a business even during times of crisis, paying attention to how management handles adversity, and having the courage and conviction, backed by research, to act decisively when your analysis suggests the market is just plain wrong.
And finally, let's touch on a more recent and perhaps initially surprising major investment, Apple. What was the rationale behind Berkshire buying into a tech giant?
Yeah, that move surprised a lot of people when Berkshire began quietly building its massive stake in Apple, starting in 2016. It has since become, by far, its largest single equity holding.
Huge position.
Absolutely huge. Buffett explained that his investment thesis evolved. He came to view Apple not primarily as a volatile technology company, but more as a consumer products business with an extraordinarily powerful brand and an incredibly loyal, almost sticky customer base.
The ecosystem.
The ecosystem is key. He saw it as growth at a reasonable price, or even value price at the time he bought it, given its relatively low PE ratio then, its substantial cash reserves, its consistent dividend growth, and the huge potential of its rapidly expanding services division. Importantly, he recognized the strength and stickiness of Apple's ecosystem, the hardware, software, services all working together as a truly significant economic moat.
Right. So less tech risk, more consumer brand strength.
That seemed to be his reframing. Now, while Berkshire has recently trimmed its Apple position, somewhat likely due to valuation concerns after its massive run-up, maybe some tax considerations, or just portfolio rebalancing the initial investment, has generated absolutely phenomenal returns.
What are the lessons there?
Key lessons include the importance of looking beyond traditional industry labels to understand the true nature and economics of a business. The necessity of valuation discipline, even for exceptional companies, price still matters. Having the courage to make very large bets when your conviction is high, and importantly, being willing to reassess and even adjust your positions, even trimming winners. As the facts, valuation, or circumstances change over time, it's not necessarily hold forever at any price.
These case studies really bring Buffett's principles to life and show how he applies them in such diverse situations over decades. Now let's discuss another cornerstone of his philosophy, taming Mr. Market. What does that whole concept entail?
Mr. Market. It's such a brilliant and useful allegory created by Benjamin Graham back in The Intelligent Investor to personify the stock market's often irrational and emotional behavior.
His moody business partner.
Exactly. Imagine you co-own a business with a partner named Mr. Market. Every single day, this partner shows up at your door and offers to either buy your shares in the business or sell you his shares. The catch is that Mr. Market's move swings wildly and unpredictably.
Manic depressive, Buffett called him.
Right. Sometimes he's euphoric and wildly optimistic, offering ridiculously high prices for your shares. Other times, he's deeply pessimistic and depressed, practically willing to give his shares away for peanuts.
So what's the point?
Graham's key insight, which Buffett wholeheartedly adopted and amplified, is that you should not allow Mr. Market's emotional daily offers to dictate your view of the business's true underlying value. Instead, you should view his extreme moods as opportunities. You can take advantage of him buying from him when he's overly depressed and offering low prices, and perhaps considering selling to him when he's irrationally exuberant and offering silly high prices.
So it's about not getting swept up in the market's emotional roller coaster, the daily noise.
Precisely. Buffett's famous counsel to be fearful when others are greedy and greedy when others are fearful is a direct application of this Mr. Market principle. He's also, as you might guess, a vocal critic of the strong form of the efficient market hypothesis, the academic theory suggesting that stock prices always perfectly reflect all available information.
His track record argues against that.
His entire track record seems to argue against it. Buffett believes significant market inefficiencies arise precisely because of these emotional, psychological reactions from investors from Mr. Market's mood swings. He urges investors to remain rational, to, as he says, check their emotions at the door, and to view market prices simply as offers to transact, rather than definitive statements of a company's true value. The key is to conduct your own independent analysis of a business's fundamentals and form your own judgment of value.
It's interesting, though, that someone who clearly believes in exploiting these market inefficiencies, who thinks the market isn't always efficient, still routinely recommends low-cost index funds for most individual investors. Isn't that a bit contradictory?
That's a very insightful question, and it seems contradictory on the surface. But it's not really when you dig deeper. While Buffett absolutely believes that skilled, disciplined, and temperamentally suited investors can indeed take advantage of market inefficiencies over time.
It's hard work.
It's very hard work. He's also a pragmatist. He recognizes that successfully and consistently outperforming the market requires significant time, deep expertise, rigorous analysis, and, perhaps most importantly, the right emotional temperament to act rationally when everyone else is panicking or getting overly enthusiastic.
Most people don't have all that.
Exactly. For the vast majority of people who don't have the time, the inclination, or maybe the emotional fortitude to become expert stock pickers, a low-cost, broadly diversified S&P 500 index fund offers a simple, sensible, and highly effective way to participate in the long-term growth of the overall economy without the significant risks and intense pressures of trying to actively beat the market.
So it's practical advice.
It's very practical advice. It's a recognition that for most people, a patient, passive, low-cost approach is likely to yield better long-term results and cause less stress than active trading driven by emotion, tips, or speculation.
Shifting gears slightly, even the legendary Oracle of Omaha, as he's called, has admitted to making his fair share of investment mistakes over the years, hasn't he? He's remarkably open about them in his letters.
Oh, incredibly open. It's one of the most admirable things about him, I think. His willingness to openly discuss his investment mistakes is really valuable for several reasons.
Yeah, it's so important.
Firstly, it just underscores his intellectual honesty and humility. He readily acknowledges that even with decades of experience and a very disciplined approach, errors are an inevitable part of the investment process. No one gets it right every time.
Normalizes mistakes.
It completely normalizes mistakes. And by candidly discussing his missteps, like his early, painful struggles with the original Berkshire Hathaway textile mills, which he calls his worst investment ever.
The anchor he couldn't get rid of.
Right, the anchor. Or the disastrous acquisition of Dexter Shoe Co. in the 90s, where he badly overestimated its economic moat and paid with Berkshire stock, compounding the error. By talking about these, he provides invaluable learning opportunities for other investors. He's basically saying, learn from my screw-ups.
What are some of the key lessons he seems to have gleaned from these acknowledged errors? What did he learn?
The lessons are diverse and quite profound. From the Berkshire textile experience, he learned the extreme difficulty, maybe impossibility, of turning around fundamentally flawed businesses in tough industries, and also the danger of emotional attachment to an investment just because you've owned it a long time.
Sunk cost fallacy.
Exactly. The Dexter shoe blunder taught him the critical importance of thoroughly analyzing the durability of a company's competitive advantages, how long will that moat last, and the significant risks of using potentially undervalued stock to make acquisitions instead of cash. He called that a mega mistake.
Using strong currency for weak assets.
Precisely. His missteps with the UK retailer Tesco highlighted the critical need to stay vigilant about management integrity and changing competitive landscapes, and also the importance of being prepared to cut your losses when your initial investment thesis clearly proves incorrect, not just hoping it will come back.
Don't double down on mistakes.
Right. Even his evolving views on the airline industry, where he invested significantly before the pandemic hit hard, demonstrate the necessity of constantly reevaluating industries prone to external shocks and intense competition, and acting decisively when the facts change.
So lots of lessons learned.
Overall, his transparency reinforces the importance of continuous analysis, avoiding overconfidence, a huge one, staying within your circle of competence and promptly correcting errors when they become apparent. He calls delaying correction a cardinal sin. Each mistake refined his philosophy.
So drawing on all of this wisdom, the successes and the mistakes, what are some concrete pieces of advice Buffett offers for the individual investor, someone listening right now who's looking to manage their own portfolio effectively?
Well, we've already discussed the 90-10 index fund recommendation for most people who prefer a passive approach. It's simple and effective.
Right, the default for many.
Beyond that, for those who do want to be more active, Buffett consistently emphasizes the importance of avoiding emotionally driven investment decisions, keeping Mr. Market in his place. Maintaining a truly long-term perspective, thinking like you're buying a piece of a business, not just a stock ticker. And resisting the urge to try and time the market's short-term swings.
Patience and discipline.
Patience and discipline are paramount. He advises focusing intensely on understanding the businesses you invest in, staying strictly within your circle of competence. He's actually wary of excessive diversification if you're actively picking stocks, preferring concentration in your best high-conviction ideas after rigorous due diligence, his 20-punch card idea.
Fewer, better bets.
Fewer, better bets, exactly. He cautions strongly against chasing hot trends or being swayed by market forecasts. Forecasts tell you more about the forecaster than the future, he says. And he constantly stresses the crucial distinction between investing, which is focused on the long-term value creation of the underlying business, and speculation, which is centered purely on short-term price fluctuations.
Investing versus gambling.
Pretty much. In terms of broader financial habits, his advice is common sense but powerful. Avoid rapidly depreciating assets like new cars bought on credit, cut unnecessary subscriptions and debt, be wary of overly large homes, don't buy low-quality goods that need constant replacement, and definitely avoid gambling or lotteries, he calls the lottery, a tax on those who don't understand math.
It all seems to circle back to some pretty fundamental, almost old-fashioned principles, doesn't it? Discipline, prudence, long-term thinking. What would you say is the enduring legacy of Warren Buffett and his investment philosophy? What's the core takeaway?
I think Buffett's enduring legacy lies precisely in his articulation, and more importantly, his consistent application over an incredibly long period of these timeless principles. It's about a deep understanding of intrinsic value, the critical importance of a margin of safety, the discipline of staying within your circle of competence, recognizing the immense power of patience and long-term thinking, the significance of identifying and investing in companies with durable economic moats run by high-quality, shareholder-oriented management,
And rationality.
and the absolute necessity of maintaining a rational, unemotional approach to the often irrational market. His wisdom is encapsulated in countless memorable, plain-spoken quotes that cut through the financial jargon.
Making it accessible.
Exactly. Ultimately, it's about cultivating a business-like mindset towards investing, viewing stocks as pieces of businesses grounded in common sense, continuous learning, intellectual honesty, and a firm long-term perspective. He has, in many ways, demystified investing for generations by emphasizing clarity, simplicity, and a relentless focus on fundamental business principles, not complex formulas or market timing.
So to kind of summarize, the core of Buffett's approach really boils down to understanding the true intrinsic value of a business, buying it only when you can get it at a significant discount to that value, that all-important margin of safety.
Crucial.
Sticking to what you genuinely understand, your circle of competence, having the patience and temperament to let compounding work its magic over the long term,
Decades even.
and focusing relentlessly on the fundamental strength of the underlying business and the integrity and rationality of its management.
That captures it beautifully.
Yeah.
And crucially, these aren't just abstract theories for Wall Street professionals. They are practical, understandable guidelines that really anyone can apply to make more informed and sound financial decisions in their own lives.
So as you reflect on our discussion today, maybe consider this. Is there one specific area in your own financial life, or perhaps in your approach to potential investments, where applying just one of Buffett's core principles, maybe focusing more intently on understanding the business first, or demanding a greater margin of safety before buying, or simply exercising more patience could make a tangible difference for you.
Good question to ponder.
Yeah, take a moment maybe later today to consider the boundaries of your own circle of competence. Are your current financial decisions, your investments, truly aligned with what you genuinely understand? It's a really valuable exercise, I think, in applying these timeless principles directly to your own situation.
Absolutely.
Thanks for taking this deep dive with us today.
Thank you. This is a great discussion.